Welcome to the fourth video in the Evaluating Farm Financial Performance segment of our Farm Management Educational Series. I'm Rodney Jones, and in this video I want to visit with you about a topic that unfortunately all businesses face at some point in their lives, and that's the topic of financial stress and the keys to successfully dealing with financial stress. Specific topics that I want to cover today include how to diagnose a farm business problem, because after all, before we can address a problem, we need to identify exactly what it is, how to make the important distinction between short-term financial stress and longer-term financial stress, and finally, a very closely related topic that often gets confused with other aspects of financial stress, and that's the topic of how large the farm really needs to be. We've already, in previous videos in this segment, talked about one of the most critical aspects of diagnosing a farm business problem, and that is to identify specifically which subset out of the 5 primary categories of farm financial performance and position that the specific business being examined has that is contributing to the problem. For example, we could have a farm that is very solvent and perhaps even profitable, but is experiencing debt repayment and liquidity problems that are causing financial stress. We could also see the opposite. Farms that seem to have plenty of cash but have persistent long-term profitability and perhaps even long-term solvency issues. Finding at least one, or even better, multiple measures that are consistently monitored to reveal position and performance in each of the 5 categories of liquidity, solvency, profitability, financial efficiency, and debt repayment ability is an absolutely essential management practice for everyone, and that practice becomes even more important when trying to evaluate and manage through a financially stressful situation. One issue that may be causing financial stress could be a size of the farm or scale of individual enterprises within the overall farm issue. This issue has a couple of different dimensions. First, what economists call economies of scale is a very real issue in many agricultural enterprises. In order to possibly be a low per unit cost producer, low cost per bushel, low cost per pound of calf produced, etc., it is sometimes necessary to spread fixed costs, machinery and equipment being a big one, over some minimal number of acres or minimal number of head. This phenomenon is particularly pronounced in commodity crop production. It becomes very difficult to be a cost-competitive producer without at least a certain number of acres to spread some of those fixed costs over, and the market will likely not allow prices to remain consistently high enough to reward producers who are not cost competitive. It's hard to put an exact number on the size that is needed because every situation is different. However, for most commodity crops grown in Oklahoma, like wheat, grain sorghum, etc., I think the evidence suggests that it would be very difficult to be a low-cost producer with less than at least a few hundred acres, and in some cases likely much more than that. Economies of scale appear to be somewhat less dramatic, if you will, for an enterprise like cow-calf production, likely because a small-scale cow-calf producer can conceivably get by with a fairly low investment in fixed assets such as machinery. That doesn't mean they will in every case, but they potentially can. The second dimension of scale relates to being large enough to fully employ the amount of labor that is relying on the farm business for some income. Every farmer or rancher is busy, obviously. The real question is, are you producing anywhere near the value of production per person on the farm or per hour of labor utilized on the farm as the farmers or ranchers in your area who are the most productive as measured by those definitions? Over time, of course, the overall market will migrate to rewarding the most productive producers in the industry, and those who are dramatically less productive with the use of their labor resource will in the long term be disappointed with the magnitude of financial rewards that their farm or ranch is able to produce. Expanding on that last point just a bit, it is essential that the farm or ranch business fully employ the labor resources in proportion to the amount of money that those labor resources are quote unquote drawing from the farm operation, either in terms of employee pay or family living withdrawals for family members working on the farm. One of the issues is that people come in one-person units. If you hire someone for a day, you must keep them productively busy for the entire day. If a family member devotes a certain number of hours to the farm or ranch operations, either part-time or full-time, then they need to be efficiently producing something of value during the time they are working on the farm, or they need to reduce the expectations regarding how much income the farm can realistically provide for them. That means constantly thinking about how to keep the labor resources productively utilized. In times of financial stress, that may mean eliminating or reducing the amount of labor that is hired. It may mean that farm family members need to seek additional off-farm employment because there are times when the farm simply will not be able to generate the needed amount of family living. It may mean adding a more labor-intensive enterprise if the farm wants to keep more family members actively engaged in farming operations. Livestock enterprises are often a good way to accomplish that. Along those same lines, it may mean expanding the current farming operation to more fully utilize the labor that is available. Financial shortfalls can often be the result of substandard physical performance. Yields, gains, etc. is not what it needs to be. Comparison of your farm's physical performance measures with benchmarks from comparable farms, even county averages can be a good place to start, is one way of assessing your farm's physical performance relative to others. You want to look at long-term averages, especially in a state like Oklahoma, where weather events in any one year can certainly result in disappointing yields. The important thing to watch is how am I doing compared to others. Physical performance obviously translates directly into economic performance, which can cause financial hardship or financial stress. Financial structure can be a very important contributor to financial stress. For most of us, debt is a necessary aspect of managing a farm or ranch business, as it allows us to grow and develop our businesses at the necessary pace. However, too much debt, for example, too high of a debt-to-asset ratio, can really magnify financial challenges. In a low-return year, interest costs can quickly overwhelm what little margin is left, resulting in the farm having to dip into equity reserves just to pay the interest. Wealth can deteriorate quickly in a highly leveraged situation. Obviously, higher debt levels mean higher annual principal and interest payments, which can result in severe liquidity and debt repayment capacity challenges. Finally, high debt levels result in less collateral cushion to fall back on when times get a little tough or when an opportunity comes along for a significant purchase that might ultimately benefit the farm in the long run. A critical question to ask and answer is whether the financial stress being felt is short-term in nature or is the problem more internal and longer-term in nature. Just to reiterate, it's critical that the exact source of the problem be identified so that the manager can get ahead of it. Short-term financial stress is usually the result of forces largely beyond the control of the manager, or what we call external forces. Things like drought and periods of exceptionally low prices are usually considered to be short-term in nature. Interest rate hikes to levels that are historically high typically do not last very long. However, keep in mind that at the time of this recording, we've been in an extended period of historically low interest rates, so some modest increases from these early 2017 levels may not be short-term in nature, but may rather be returning to more normal long-term levels. Poor debt term structure can be the result of a one-time purchase event that just needs to be refinanced. For example, A farmer may use his or her operating credit line to purchase a significant piece of machinery at an auction over a weekend. That person just purchased a non-current asset using a short-term debt and really needs to go in and visit with the lender about stretching that debt over a few years to be more consistent with the expected life of the underlying asset. Sudden and dramatic drops in collateral values, like what happened with land and equipment values in the 1980s, can cause financial stress. Lenders may become concerned about their collateral margin if, for example, they loaned 70% of the value of a land purchase based on values a few years ago, and in the meantime, land values in the area have dropped 40% or so, for example. They, or their regulators, may insist that the collateral margin be increased in some way, shape, or form, which can certainly cause short-term financial stress. Agricultural producers have three basic lines of defense when short-term financial stress begins to show up. They can respond by managing cash flow, managing liabilities, or managing assets. More details on each of these strategies in the next few slides. The first signs always show up as a cash shortfall. We simply don't have enough cash in our checking account to pay the bills that are coming due. We manage cash flow in several different ways. Our first line of defense is to control costs. We carefully figure out which costs in various enterprises can be reduced without harming production very much or at all. Oftentimes we become a bit lax during the good times and find that we can tighten the belt a little bit without really impacting productivity when times get a little more challenging. As this video is being recorded, producers all over the United States are having discussions with landlords about renegotiating cash rents due to the tight crop production margins. In fact, I've had a couple of calls from producers just in the last week or so regarding how to initiate some of those discussions. No guarantee of success, but if the landlord discovers that other producers in the area have the same concerns that you do, and the rental market is in fact softening, there may be some room for renegotiation. Another common cash flow management technique is to simply delay large capital purchases or repair for another year or so rather than replace. Cutting back on family living withdrawals from the business is another common response. Finally, figuring out ways to get some cash out of underutilized equipment or facilities, or increasing non-farm income sources are common responses to short-term financial stress. Ways to manage liabilities include negotiating extended loan terms, or even negotiating the opportunity to make an interest-only payment for a year or so. Recent surveys of agricultural lenders reveal that renegotiating existing loan terms has been a very common practice over the past year or so, as financial stress has increased in the agricultural sector. Liquidity positions can sometimes be improved by mortgaging long-term assets to borrow additional funds to pay the bills with. Sort of an opposite approach, sometimes debt can be reduced by selling unproductive assets or by utilizing off-farm income or off-farm capital sources to pay down debt. Managing assets to address short-term financial stress involves liquidating assets to pay bills. This may not be a bad strategy, especially if the farm or ranch family has some assets that are otherwise not very productive. One thing to keep in mind is if you are selling low tax basis assets, there may be income recapture or capital gains tax consequences to consider. If the financial stress problem being experienced is persistent even during times when other agricultural producers in your area are doing well, then that's an indication that the problem is not entirely external, but may be an internal fundamental profitability or financial efficiency issue. The short-term strategies that we just talked about will not solve the problem if it is in fact a long-term profitability problem. Reasons for the profitability or efficiency problem will need to be identified and resolved. This can take time, and there may need to be some asset restructuring in the meantime. Financial stress is often confused with profitability, meaning that it is quite common to see a farm business that is fundamentally profitable, but just not large enough to support the level of family living that is being drawn out of the farm. This issue frequently shows up at generational transition time, when a farm that has historically been supporting one family is suddenly asked to support more than one generation for a while, as the younger generation returns to the farm to get started. For the purposes of this discussion, I'm going to assume that the farm and its various enterprises are of sufficient scale to address the issue mentioned earlier, that of being a reasonably low per unit cost producer. I'm also going to assume that there are not access to market issues, which for some enterprises can be an issue if scale is not sufficient to attract a buyer. The farm simply needs to be of a certain size to get the attention of relevant buyers in some instances. For most of our commodity farm products, that's not an issue. So I want to focus on the issue of farm size as it relates to meeting the income needs or the family living needs of the various operators that are working on the farm. That question can be addressed by answering 3 questions in sequence using some basic information from recent financial performance. The first question: what are the net income needs from the farm? This is primarily family living needs, but it can also include a little bit of a cushion for growth over time. Based on the answer to that first question, the second question is: what level of gross income or total farm sales would be needed to produce the amount of net income revealed in the answer to the first question? The third question is: how much of an investment or how big of a farm is needed to produce the level of gross income revealed in the answer to the second question? Let's say, for example, that a part-time farm operator would like for the farm to generate, say, $15,000 per year on average for family living and equity growth. There's the answer to question 1, $15,000. We can use the recent historical net farm income from operations ratio, basically the net income divided by the gross income, from that exact farm to then answer question number 2 in a very systematic mathematical fashion. We simply divide the net income needed number, the 15,000 answer to question number 1 in this example, by that net farm income from operations ratio. The example I'm going to use here is a common average measure for that number, say 0.12 or 12%, and that division reveals the answer to question number 2. In this case, we need for the farm to generate an average of around $120,000 per year in gross income in order to meet our goal of $15,000 net income. We then take that answer to question number 2, the $120,000, and in a very systematic way, we divide that by our firm's recent historical asset turnover ratio. That's the gross income divided by the value of the farm asset base that we're managing, to arrive at the dollar value of the asset base, farm size, needed to accomplish our original goal. Well, that's interesting, but it's sort of mathematically self-fulfilling, right? We're using the farm's historical performance numbers to tell us what the farm is already doing. The more useful application of this approach is when there's an impending change. In the example I mentioned, perhaps an additional person wants to come back to the farm and would like for the farm to generate, say, $50,000 a year for them to live on as a full-time farm operator or manager. Let's see what the analysis tells us in that hypothetical example. Now, instead of $15,000, we need an additional $50,000, or a total of $65,000, to accomplish the goals that we have in mind from this farm. So the answer to question 1 now becomes $65,000. We use this information and that exact farm's recent historical net farm income from operations ratio to quickly discover that the farm would need to generate about $540,000 in gross income to make that happen. Answer to question number 2. We then use that information and that exact farm's recent historical asset turnover ratio to quickly discover that we need to expand the farm to about a $3.4 million asset base in order to accomplish that goal. The answer to question number 3, how big does the farm need to be? Going through this simple analysis can help facilitate discussions about how to get there over time and can help avoid the pitfall of just jumping in blindly and hoping it will all work out, which can create significant financial stress in a very short time period. Thanks for joining me in this discussion of financial stress and related issues.